Today we're talking about how prop firms handle news trading. If you've ever looked at the rules of a prop firm, you might have noticed this. They don't always love when you trade during a major news event. Some have time limits before and after news. Some don't. Some have soft rules. Some are more strict. News trading means placing trades during or right after big news events. Things like non-farm payroll, interest rate decisions, CPI, FOMC meetings, big speeches from central banks, or even unexpected world events that shake the market. When that happens, the market can go wild. Prices jump very fast. Sometimes they shoot up, sometimes they drop down. Sometimes they do both in the same minute. During news, spreads get wider, way wider. That means the difference between the buy price and the sell price gets bigger. Normally it's small, but during news, it can grow 5 or 10 times bigger. This makes it more expensive and a lot more risky to trade. And then there's slippage. That's when you try to open or close a trade at one price, but the market moves so fast that the trade fills at a worse price. Sometimes a little worse, sometimes a lot of worse. And that can cause big problems. For a trader using their own money, sure, it's your risk. But when you're a prop firm's money, it's the firm's risk too. If traders lose a lot because of bad fills, wide spreads, or huge spikes, the firm loses as well. So they create rules around it to protect themselves. It's not just about the firm either. News events can cause stress. Fast price jumps make it harder to stay calm. Some traders panic. They close trades too soon, or they move stop losses, or they overtrade. Prop firms prefer when traders stick to planned, steady strategies. And news trading doesn't always fit that. So how do the rules actually work? It depends on the firm. Some have a small time window. 2 minutes before or after news, no trades. Others use 5 minutes. Some even use 10. It changes depending on the company. It's really important to understand what happens if you break the rule. Some firms have what's called a soft breach. That means if you trade during a restricted time, they won't count the profit from that trade, but your account stays active. Others are stricter. You break the rule and the account gets closed. Simple as that. Now, do all traders hate news trading? Not all. Some traders actually love trading news. It's their main strategy. They look forward to those fast moves. They know how to manage the risk. But other traders avoid it completely. They wait until the market calms down. There's no right or wrong, really. It depends on the trader. So if you trade news, pick a firm that allows it. Never skip reading the rule book. A lot of traders get caught by surprise. News trading can be an opportunity. It can also be a risk. The fast moves are exciting, but spreads, slippage, and a big price jump make it harder. That's why firms don't love it. They allow it in many cases, but with limits, to protect you and themselves. Let me know in the comments. Do you trade news or do you avoid it?